Well, hello everybody. Welcome, welcome. We're doing the classic screen share again, which is always so fun because what we're going to do is we'll open up our Discord again and we're going to go through your questions and your deals. I'm going to start off though. Let me get our chat over here so I can see what y'all got going on in chat as well. And then we're going to get together and analyze your deals, answer your specific questions. And then, of course, we've got some more lecture content coming out as well. Actually, really excited. We've got a nice plan going for where the rest of the lecture content is coming from and how we're getting that all done for you. It's going to be really great because there's always so much detail to add. I think that's what makes an investment course so difficult to actually produce is there's so much to talk about when it comes to real estate investing, but it'll be fun. So the big thing that I want to start by starting this lecture and talking about is the concept that we've talked about opportunity cost in our real estate lectures, but what we don't talk about or haven't talked about maybe as clearly as I'd like is that to me, anytime you're looking at investing in real estate or you're looking to make any kind of investment decision, you should be asking yourself, how does this decision that I'm making today compare to decisions that I've made in the past? To me, that is the best benchmark. So, for example, when I'm currently in escrow on buying a property, as I mentioned last week. So I'm buying this property that's $650,000, and say $30,000 went into it, it'd be worth 775. So it's a great property. It's a wedge property, and for the purposes that we're using it for, there's even more, right? Where we've got this backup strategy that if we need to rent it, we'd cash flow. If we needed to sell it, it would make a profit because it was a good purchase. But it also works really well for our purposes, which will be announced later. But when I looked at that deal, I didn't just compare that deal to, oh, let me run that comparison to Apple stock or Tesla stock or what if Netflix doubles in value? No, instead, what I did was I compared that particular property to all of the other deals that we have owned, currently own, or whatever, or have analyzed. And I look and I go, okay, how do these numbers, the cash flow, if we rented it, everything, how do these compare to other deals that we've done? And that all of a sudden makes real estate investing a little bit easier because now in my situation, I'm already convinced that I want to put as much money as possible into real estate because of appreciation, the tax benefits, the fact that I can buy deals for under market value. I mean, why is it fair? Well, look at it this way. If I could put $650,000 into Apple stock, let's say with closing costs and repairs and things like that. Let's say I could put $690,000 in Apple stock. And if somebody told me that was going to be worth 775 tomorrow, I'd be like, yes, give me more. I want to do these deals all day long. And for me, I that's why I'm so convinced about real estate. But then I can compare my the current deal that we're doing to past deals and see, okay, maybe it's better, maybe it's not as good, but it's still a very strong deal. And for our purposes, we're like, this is great. Let's get into it. And so the message that I want to convey to you is you got to have something to compare your choices to, and that makes life a little bit easier. So let's break this down a little bit. Let's say you've never bought real estate before and you don't really have anything to compare to. Well, here's what you can compare to. You can compare to the fact that when you're renting, you're paying off somebody else's mortgage. You are getting the right to live in a space and you're paying off somebody else's loan. You're not getting the tax benefits. You're not getting the appreciation. You're not getting any of the benefits of a wedge deal. So, right away, the difference between paying rent for $2,500 a month or $1,500 a month and owning for $1,500 a month or $2,500 a month, there should be no reason for you to be renting. The first and most easy decision you could make is making that transition and getting over to owning and controlling real estate. Now you have your first metric. You go, okay, all right, fine, Kevin. I'm going to get into a house that needs paint and carpet, and maybe I'm going to buy a house for $200,000. I'm going to get it inspected with. I'm going to surround myself with the right professionals to make sure that I'm not getting into a total disaster of a property. And then you're going to get in, say you get in for $200,000 and hey, it was a small wedge. Let's say it's worth $230,000 after I spend a quick $5,000 on it. Small deal, right? Small wedge, small deal, pretty easy. relatively safe. Even maybe this is a condo or whatever, but you're still trying to buy it right. Now you have something to compare to. And so now you look and you go, oh my gosh, here's an opportunity a year later. I could buy this $275,000 house, put 25 into it. And, oh wow, it'd be worth 360 later, something like that, right? But now you're comparing to your first deal. It's like, well, the first deal I went through, we did a little bit of stuff and we got a return on that and we control that property and the numbers make sense. It cash flows if we go to rent it out or whatever. And now I'm motivated. Now I'm in. Now I'm feeling like, okay, I can catapult this and translate this into another one. And then you sort of keep going along that course. So let me compare this to make it a little bit more clear. Let's do this. If you know that Coca-Cola, let's say, is paying you a 3% dividend every single year, that's kind of like cash flow in real estate is your dividend, right? Hopefully, you are reinvesting that cash flow, that 3%. And then let's say your expectation is the stock value is going to go up 3% a year. So you have this combined increase of net worth of 6% in this Coca-Cola stock. And you think for the next 100 years, you should be able to average out this 3% dividend and 3% growth in stock to give you a 6% return on Coca-Cola. Well, now you look and say, okay, well, that's pretty easy. Analyzing a company like Coca-Cola is easy. They're producing Coke and they're selling it. It's relatively simple and basic to look at. So now you turn around and you go, okay, now I'm going to invest some money into, I don't know, Toyota Motor Corp. Well, relatively basic because they're producing cars and selling cars. And so you look and go, okay, well, my long run expectation is that this is going to make me 7% a year. And then you evaluate, well, what's the risk factor? But you look at it and you go, I'm comparing everything to Coke. If Toyota is an uncertain 6% and I'm comfortable with my Coke at 6%, why not just buy more Coke? So Coke. But if you constantly compare your decisions to something that you're comfortable with, and what you're comfortable with is a good investment, then deciding whether or not to say yes or no to something. All right, thanks for guarding that test name. And whether or not to say yes or no to something becomes very simple. Here's some takeaways for this little segment, and then we're going to get into some more detail in terms of deal analysis and things like that. It's a good takeaway. People ask me all the time, they're like, hey, Kevin, why don't you come invest in oil stocks with us? Like, well, I don't know anything about oil. Can I get a wedge deal on oil? What are my tax benefits on oil? And is it going to appreciate in value? And all these things. And all of a sudden it's like, people throw these numbers at you like, well, you could get this appreciation and these tax benefits, and then you could do this and you could do that. And I'm like, why would I complicate my life with something so complicated when I know I could get a good deal in real estate and I could just keep doing more of that? So that's why I'm such a fan of real estate. Although obviously I invest in stocks, I invest in other assets as well. But the reason I invest in stocks is really just to buy more real estate. Helps me cover the reserve requirements. So anyway, it's to me that's a very important lesson to sort of internalize in yourself. If you do not own investments, go buy something so that way you have something to compare it to. Buy a small condo even. Great. Break the ice. Get in. And then every subsequent deal after that, you can compare it to that. And then keep doing what's working. If an investment is working, keep doing more of that until you find something that is a slam dunk better investment. Look, you could say dump a bunch of money into Tesla and maybe it'll go to $600 or maybe it'll go to zero. There's so much uncertainty with like tech and all these investments that we really don't have a clear history on or an understanding of. We know we can't get in with a margin of safety. Don't get me wrong. That's not saying I don't believe in Tesla. That's not saying I don't buy Tesla stock. I do. But the vast majority of my investments go into things that I consider safe and easy. And that just happens to be real estate because I think real estate's really easy. It's really easy to see this is what it's selling for. This is what it needs to fix it up. Nobody else is seeing it. There's not that much competition in my area. And when I buy it and after I buy it, it's worth this. Great. My net worth is that much higher. We keep doing that. To me, it's easy. And that's what I want to convey to you with these lectures. And that should be the overarching theme. Another overarching theme is that real estate should be your side hustle. And we've talked about this in the lecture, so we won't go crazy detail into that. But so many folks are like, hey, I want to do this full time. I want to be a wholesaler. I want to do this. I want to do this. That's fine. If you want a job and you want to have a job going hunting for deals, or you want to put deals together as a real estate agent and you want a job, fine. But real estate can really be a side hustle because it's limited by your cash, right? So I don't really follow real estate stocks. I'm trying to buy a new primary residence while keeping my current one and renting it out. I love that. Where I run into problems is how I qualify rent on this property when I don't exactly know when I would be moving out. Yeah, I mean, so you just have to pull the trigger and tell the bank. So I don't know exactly when I would be moving out. I can't offer a lease to anyone. So that means to the bank, I would need to be able to finance both mortgages at the same time with no proven income. Yes. So here's how you solve that. Generally, what you want to do is so this is a great question. Let me recap the question really quick. When you own the property that you're living in, let's just say this house that I'm in right now, it's a $750,000 house. And let's say I want to buy another property and I'm going to move into it. So what you do is you say, okay, I've identified my property that I'm going to move into. You tell your banker, I think I can rent this $750,000 house out for say $3,500 a month. And what they're going to want is they're going to want an appraisal on the one that I'm in now to justify that, yes, I could probably get 3,500. They usually go based off that. Then you identify your property to buy. You buy the other property. You get the other property into contract. And when you're in the contract, now you could you say to the lender, okay, I've got my deal number 2 into contract. That's the one I'm moving into. Let's get the appraisal ordered on the new one and the old one. At the, once you get through your inspections on the new property, you do your home inspection, you get your appraisals done, you get your loan approval and all that done. You have to start advertising the property that you are in now for rent. Now, generally, you're going to start maybe midway through your escrow and you're going to advertise it as available for rent about 45 days out. So let's see, let's say it's Feb 15th. You advertise this property as available for move in, let's say either March 15th or April 1st. Advertise it. Even if you have to drop the rent a little bit just to get somebody fast because you don't want to be in so much turmoil. Like let's say the market rent is 3,500, whatever. Hey, special today, year one special, get it for 34.25. This thing would be rented like that, be rented so fast. And now all of a sudden you're in, and what you're going to do is you're going to find a tenant. Obviously, I recommend you work with a property manager, but once you find with a tenant, properly screen them, right? We talk about screening all the time. Credit, social security cards. We'll make specific lectures on exactly what to do. And I already have some YouTube videos on exactly how to screen tenants. If you want to look those up, you can for now. But then you sign your lease. You take your deposit from that tenant. You give the lender the lease and the deposit check that you deposited, and there you go. Now you're qualifying for that rent. So there's some orchestrating to do. Now, some people maybe go a little bit more of a shady direction. This is how it's supposed to be done, what I just described. Some people take it a little bit, maybe into their own hands, and they're like, hey, Billy Bob, I need you to sign this lease and give me a $5,000 deposit. And then Billy Bob rents the property. And in reality, people are just using that as a way to show the lender that the property is rented, and then move. They close the deal, they move, then they really put it for rent when it's empty and you're out of it, and the deals are closed and everything's done, and the stress has sort of gone away, and you give Billy Bob his 5Gs back, and then you really put it up for rent. Now, technically, you shouldn't do that. My point of view is that the intent is what matters. That's a big thing because the lender wants a tenant in within 60 days after you move. And I think anybody can match that intent to, once the deal is closed, get a tenant in there within 60 days. Now, obviously, it would be wrong if you did nothing to the house and didn't rent it out. But that's where you kind of start seeing some of the kind of like tricks you have to play and the games you have to play. And so somewhat that's just the nature. So how do I know that putting $30,000 in will increase the value by $100,000? Newbie, that's a great question. And really, it's the comps in the neighborhood. So when we look at comps in the neighborhood and we say, oh, okay, yeah, this Model 2 house, it's a 2003 built neighborhood in a tract home. This Model 2 has a history of selling for between, $750 to $800,000. If it's just in a relatively basic move-in ready condition, well, there you go. The comps are substantiating your value. This just happens to be such a low sale, even though it had multiple offers because the owner was very picky with the offer that she wanted. She didn't want any kind of contingent deal. She didn't want to do any kind of repairs. She didn't want to do any termite inspections, sewer inspections, all the normal things she didn't want to do. She wanted a quick close. She wanted a non-refundable deposit, which all these things were fine because I looked at the property and it was stinky. It's got nasty paint. There's a broken window. Like all the cosmetic stuff is kind of gross. So you go through there, it's like, oh, this is grimy. And people are like, I'm going to have to put in a $200,000 remodel. No, you don't. So, okay. So hopefully that answers your question, PW. In one course video, you mentioned that you could tell the market was about to dip because the stock of a company was showing signs similar to. Oh, okay, yeah. So I've talked about Lennar and Toll Brothers stocks. The interesting thing about home builder stocks is that they really lag the housing market. So they will put out really strong earnings for about another 6 months, even if the housing market is starting to show signs of slowing. So it's actually kind of the inverse. It's if the home builders are still cheering, the market could have shifted and changed, and then all of a sudden you see the home builders come in later. So home builders will lag in their enthusiasm. But the cool thing about that is if you wanted to invest in home builder stocks, you could probably get really good deals by, if you see the market turning, shorting builder stocks, or if you see the market turning up again, buying builder stocks. They're very slow to react. So, you mentioned why I'm selling when I use an FHA for my new home. I figured out. Okay, so I'm gonna retranslate your question here. So you're selling a property and you're using an FHA loan to buy your new home, which is a 3.5% down loan in America. I figured with very little to no cash flow, it was worth it to sell versus keep and rent it out. I don't know. It depends on your area. I personally think keep the property, control the property, and even if you look, I get this all the time. People leave these comments on YouTube. They're like, "Hey, wait a minute. If the cash flow is zero, why are you wasting your time and dealing with a headache of tenants?" Or like people say, like, "Oh, the cash flow is $200 a month. Wow, for $2,400, you have to deal with tenants. Loser." Like they have these kind of lines that they think they know what they're talking about. When then in reality, we look and say, well, wait a minute. This $200 cash flow on, let's say, a $300,000 property allows me to pay off the loan by $500 a month. There's another 6 grand. It gives me tax benefits, oftentimes to pay for my cash flow, or sometimes even in excess. There are excess tax benefits thanks to depreciation. Or the market goes up. Oh, wow, the market went up 5%. That's another 15 grand in net worth. So all of a sudden, it's like $2,400 in cash flow. We start factoring tax benefits, appreciation, principal pay down. Now all of a sudden, this $2,000 cash flow really starts looking like a yearly net worth bump of sometimes anywhere between 20 to $40,000, depending on how strong the market was at the time. So the idea is internalizing that as sort of maybe your long run average. And then, of course, there are going to be peaks and valleys and ups and downs. So, things to keep in mind. But I think the best thing for you would be to punch in here. Yeah. So give me the details. What's the property worth? What could you rent it out for? And let's talk about some of the details. So now, since we're screen sharing, let's go ahead and hit some of your questions here. So we're just going to go up from the bottom. You guys definitely. Oh, let me show myself again here. There we go. See, this is the thing about the screen shares. I get to put myself wherever I want. All right, so we got some book recommendations here, folks. Definitely always nice to read. I think a lot of us don't read as much as we really should. So let's look at okay, base Trump. All right. Let's get into some of our new messages here in personal finance, and then we're going to work our way over to deal analysis, and we'll knock out some responses here. So let's see. Peter Schiff. So here's the thing. Base Trump invests in gold. He's in our group as well, which I really appreciate that he's here and sharing his perspectives. It's one of those things where you have to ask yourself, what do you want to invest in? What do you believe in? I personally don't care about what the market does. I don't care if the market goes up or down because I have tenants that are paying off my loans. There's enough cash flow to where even if the market fell and I had to reduce rents, it doesn't matter. My loans are still getting paid off. I'm still getting tax benefits. And in the long run, I'm still holding on to properties, onto real estate that generally goes up in value again over the long run. In my opinion, gold is the kind of investment that is good to invest in if you need to preserve sort of shorter term gains or prevent shorter term losses, or it's sort of a way to protect yourself against the overall direction of the global economy. That's the theory, at least. But just like anything, there's no set rule for gold. So I can't speak much to gold other than I think the purpose of investing in gold is to remove yourself from other investments. It's to limit your exposure to stocks and real estate, and maybe sort of hedge your bet against those things. And to me, I think that's a mistake, because to me, I like real estate because I can get good deals on real estate. That's my take. So check today's live about 21 minutes in. There you go. So see, I always want to engage with y'all and give you all replies. And the easiest way for me to do that is here with you folks, where I could also chat with you and see what we've got going on. So let's see. Here's a good one. So if you wanted to make passive income of between 30 to 40K a year, what's the best strategy to go about it? Solar mining's in here a lot. Works on solar panels. Appreciate you being here. So the thing is, yeah, I mean, Newbie's right on here. And Newbie, you're in our chat right here too. Yeah, I mean, if you wanted simple, if you wanted just the simple life, you could throw money into a dividend stock, right? It just there are questions missing from what you're asking, and really, we shouldn't be able to use the everyone tag here. So let me kill that really quick. It is killed. Oh, so that must mean it didn't work for him. Okay, good, because I don't want you guys to get killed with notifications from everybody. So, uh, 35 to 40K a year. Uh, the questions are, how much money do you have? It's all about personal finance planning and sort of coaching, right? So, how much money are you starting with? Do you own real estate? And then you want to evaluate, do you have a job? A lot of folks, and that sounds like it's simple, like, do you want to evaluate, do you have a job? Yeah, I have a job, or no, I don't have a job. So many people are trying to get rid of the fact that they have a job or need to have a job. And I think the real purpose of a job is actually to help inspire you and motivate you to buy real estate and control assets. So let's see what else we got here. Let's see. So let's reply to solar mining here, and then we're gonna hit some deal analysis deals. We're just gonna respond to some of these. So we got 22 minutes in today's live. Okay, cool. So that's why I also mentioned that real estate is a side hustle. It's something where you should really internalize that you have a job, and you can use the profits from that, the money from that, and invest it into whatever you want. Look, if you want to throw it into real estate, great. If you want to throw it into gold, fine. So many different ways you can go. And yeah, I mean, it's so true. There's a lot of volatility in gold as well. I see that. I mean, I look at the gold stocks too, and it's just like a stock. It's a graph of emotion, is what it really is. So let's see what we've got here. Okay, we'll circle back to you Knights here. Let me hit the deal analysis section here. So we got caught up to this point. Perfect. But that house had an elevator. I just found one on another estate home that came up from the MLS. What's your opinion? It was listed for. Okay, so I'm going to hit Rambling's question here, and then Knights, I'm going to answer yours. So, Rambling, what do we got here? We got a property that was listed in August. So, a lot of this is important to know. A lot of what happened in August was actually a lot of properties were listed high in August because people were looking at comps from April and March. And remember, it's so interesting. If you're intertwined with your local market conditions, and realize, oh, wow, wait a minute. The market was booming, let's say in March, April, and May. And so somebody selling in August was probably using the comps from that period of time because a lot of the July sales hadn't closed yet. So we know that somebody's probably pricing high at that point. And a lot of those folks never ended up selling unless they really adjusted. So August, it was listed for at 430. They dropped it to 400, and today it's 350. This isn't a surprise. So basically, what they did is they took those high comps and then they priced above those high comps, thinking the market was still going up. When in reality, Had they priced it at 400 maybe in August, they would have actually sold. Now they're at 350 because a lot of our early part of the year gains were eradicated during 2018. 2018 is going to go down as a very flat year. I mean, prices went up and then they came right back down. So it ended up pretty flat for 2018. And when you internalize that, it's going to help you a lot in negotiations, is understanding exactly what's going on in your marketplace. So many of us forget that real estate is so local, and we really need to analyze exactly what's happening in our marketplace and then align our negotiations with that. So also, how come homes like this had been on the market for over 6 months? So it's, to me, it's not a big red flag. To me, the fact that this has been on the market for a while is just a sign that either the agent uh, and the seller, or just the seller, were not as responsive as they should have been to the marketplace, and that's really their loss. That's their fault. So I don't see that necessarily as a property issue. So let's see what we've got. We've got half an acre built in 65. I mean, yeah, especially a house built in 65, you're usually not going to see any kind of crazy issues that would indicate that the reason it's been on the market for 6 months has anything to do with anything but price. In other words, the reason it's been on for 6 months is because it's overpriced. Very important. Take this away. Like, if you're taking notes or you're writing this down, write this down. Write down. If a property's on the market, that is, whatever main means of distribution is normal for your channel, for your market, for your area. If that's the MLS, if it's Zillow, whatever it is, property is on that for more than 7 days in a normal price range, a median price range. Not talking about necessarily like the super high end, in a median price range. If it's on for more than 7 days and there are no offers, the listing price is too high. It's that simple. Okay, so yeah, I mean, I don't see any massive yeah buts right away. It's right outside of Atlanta, which is good. Booming economy in Atlanta. Outside of Atlanta, you can get some pretty incredibly low priced properties, which is always something I look at as somewhat of a red flag when you start getting around really low priced properties. Or next to apartment properties, this is good. When you see developers, when you see interchanges like this, and you see massive apartment complexes, it's a good sign that people are paying attention to this area. And you happen to be relatively close to these things, the movie theater. So I look at this. What do we got over here? Wow, look at the massive plaza over here. This is very good to be around these things and to see the kind of stores. I mean, Best Buy isn't the cheapest store ever. Kroger's got their corporate office here. This is great. I like this. And another apartment building over here. You know, it's when you start getting like, if this, all of this was like thrift store, thrift store, thrift store, it'd be more unnerving. Look, that almost looks like a new build. These apartments over here. See all this land here is when they were constructing it. Yeah, it is exactly. So this is probably all built out now. These are the kind of things that, obviously not being on the ground, are a little harder to analyze. But yeah, look, all those apartments are up now. Yeah, I mean, great. I love that. So you've got a larger property here, so you're actually not really competing with the condos because it's a larger property. Okay, so it's 399 now. I think you were thinking 350. Yeah, I mean, look, I would write it up. Even if you, I mean, run the comps on this as we've done here before. I'm going to jump to another analysis here, but run the comps, and I want to see that these comps. Let's see. You want to find properties that are in a similar condition. There are no pictures of the inside. Let's see if I could say throughout hardwood floors, tons of storage, cozy den. All right. So the odds are it's like a 70s dated interior with, the shag carpet and the older paint, the older kitchen, the older bathrooms. So really what you want to do is you want to start finding what are our flips selling for, or what are other things selling for in the area that are the similar square footage, plus or minus 15% is what I always recommend. It doesn't look. Look at this right next door. This is great. When did this sell? 2017. That's great that it's larger. This is over 1,000 square feet larger, but it's great that this place sold for $130,000 more. Now, how remodeled? It looks pretty remodeled. There are no other pictures, so it's hard to compare when something's so much larger. But I like that is your neighbor. It's nice to see that. If your neighbor was selling for $200,000, it'd be a little bit more of a problem. What do we got here? So here we've got one that also sold for 399 in 2017. So we've definitely seen some appreciation since 2017. And this is a pretty basic. I mean, it's got the newer kitchen. It's got some nice features. I'm flying through this, I know. Uh, they made that. They got a lot of different colors going on. That one gray room was pretty nice. This kitchen, it's a mid 2000s remodel. So you've got remodeled properties selling for. This would probably now just doing some quick appreciation math, this is probably going to be worth 425 to 430, 440 right now. It probably sell pretty quickly. That would mean if yours was in the same condition, it might be worth 450, 460, but it's not. That's why it's having trouble selling for 399. So the flippers are going to try to buy yours for 325. And yeah, you know what? You're probably right, close to your 350 mark. So let's see what else we got here. Knights, I wanted to touch on yours. So you've got a 2008 tract home worth $300,000 in a 200 to 250K neighborhood. So how do you know yours is worth 300? And why is the neighborhood less than yours? So it's worth 300K. You owe 216 on it. The rental market is 1300. Would need to rent it out for a 3, 2, and a 5. Would need to rent it out for 1500 to break even. Okay. So and you probably bought this relatively recently, right? The MLS has it at 350. Oh, hey, rambling. So very, very interesting for you, and good to know. And I'm just gonna mention in here so other people know that, and I later know that I addressed yours in today's live. It's just sort of for my own like little mental organization here. So this is a good thing. This is really, really good. Folks, look at this. Let me make sure you guys are still here. Yeah, you're still here. Okay, sorry. Watch this. Rambling is saying the MLS has this place listed for $350,000, and on Zillow, it's listed for $399, which is this property. Watch this. That is great because guess how many people only use Zillow? A lot. But Zillow isn't that great with staying up to date, and the agent's not paying attention to Zillow. So this is a great opportunity for you to almost pounce on a deal that nobody else knows about. This thing's selling for 350, write a 325 offer, lock it up for 335. Get me some pictures of the inside. I want to see this place. This I like. There's some potential here. That's really good. Now it's even more exciting. Now you can really mess with the sellers. Yeah, okay, so Eric, yes, there have been a lot of price reductions. Why? There's still going to be more price reductions. Here's the thing. And I know this is backwards, so I'm going to do some zigzagging here. How does this look? You guys can figure it out. Market went up. Market went down when the Trump tax plan really hit the market hard somewhere around the middle of 2018. At the same time, the Fed started raising rates and indicating that they were going to be relentless and continue raising rates. And so all of a sudden you had sort of these three things that killed the market in the summer. And so what are we seeing now is we're seeing this, a lot of that, possibly even lower, like down here, we're bouncing around much lower. So we really sort of eradicated our gains for the year, and now we're kind of bouncing around beginning of 2018, end of 2017 pricing levels. And so why is it important to realize what's happening here? Well, you still have sellers that are using comps from here and here and here and here and here. And they're like, oh, yeah, I want to price my property over there, there. And they're not realizing that we're really bouncing around in the dirt over here at the bottom. So, yeah, you should expect to see more price reductions. I'll write a little note there. Okay, so Night, is that the one that you're in right now? Okay, so this is what you bought. So Knight's here in our chat owns this property and says it's worth $300,000. It is a 2,400 square foot property, and you think that you should sell it so you can go buy something else. Okay, let's see. Why are these places selling for less? That one's 300 square feet smaller, sold in 2016. When did you buy yours? Let me find that out. And then we're going to do a quick load. These are all the smaller floor plans that you're talking about selling for the lower levels. So you bought it in 2008. Oh, wow. You've been riding onto that one for a while. Uh, yeah, so I'm going down the deal analysis test name as much as I can. So you've owned this property since 2008. You bought it for $235,000. You've paid it down about 20 grand. You bought it with an FHA loan. You would have to rent this out for $1,500 a month to break even. You've had the FHA loan now for over 10 years. Yeah, but watch this. Watch this. Mortgage calculator. You bought it for 9735 times 235. You when you first got this place, you had a loan of about 228,700. Come on, 228,700. 2008, I don't know, let's say your rates with mortgage insurance, you might have actually been able to get rid of mortgage insurance because you had a loan that was generated, an FHA loan that was generated before they got rid of the right or the mandate that you have to maintain mortgage insurance. So let's say you've got a rate of like 4.25 thing on this. That makes sense. Right? You'd break even around $1,500 with your property taxes and your pay down and all that. So I'm guessing your rate here, but I think I'm going to be pretty dang close to what your payments are. And it doesn't really matter with what I'm going to do for you here. So the loan was somewhere around 228. Can I just, yeah, I can. Okay. Let's go back to 228,700. You folks will see what I'm going to do here. Down payment 4.25. Okay. And let me get rid of all this other extra stuff. These calculators, they always add this extra stuff. I don't want the extra stuff. I just want to look at the actual amortization schedule. So here's what I want to do. When you first got this loan, you were paying off the loan by $1,300 a month. But because you had this loan for 10 years, you are actually paying off this loan by about, when did you, it's going to be somewhere close to $500 now. So you bought it at the end of 2008. So at the end of, actually, you're already here. You're already on your 10th year because you bought it at the end of 2008 and we're 2019 now. So we're somewhere at the beginning of your 11th year. You're paying down $500 of this loan every single month. So then you ask yourself, if with property taxes, insurance, maintenance, management, utilities, reserves, if all in, you would break even at $1,500. And let's say you had to rent it for $1,300. This property would cost you $2,400 per year to control. So you're in the hole, negative $2,400 a year. But you're paying off, or the tenant is paying off $6,000 of the loan every single year. So you're in the hole 2,400, but you're up 4,600 in principal pay down alone. If property values go up 1%, you're up another 3 grand. And so if we say property values go up 1% for the next 20 years, here's 3 grand plus $4,800 or whatever every single year just for controlling this property, assuming you factored in that your $1,500 is going to include your property taxes, your insurance, which it should. Property taxes might be $200 for you. Your insurance, you'd be somewhere around 1,350 plus insurance, 1,400. You might manage. I don't know if you're managing it yourself, but you'd be somewhere around that $1,500, $1,600. Put aside $100 or whatever for repairs. Usually, I like to put aside a couple $100 for repairs and reserves. But look at this. This is the other aspect that I saw. It's a brand new construction home. You just left the builder warranty period because it's 10 years old. 10-year-old property, and it looks like you're going to be in you probably have some associate. No, you're a single family house. You're a single family house that's 10 years old. You're probably not looking at any issues. It's a composition shingle roof, so you've got at least another 15 to 20 years on your roof. The stucco looks fine from whenever they took this footage here. You're not going to have issues with your windows. Your heating appliance should last another 10 years, as well as your air conditioner. Your water heater, yeah, that might be coming up, But I mean, that you're not going to be probably worried about your foundation. It's 2008 build. I don't know. I wouldn't get rid of this thing. I just see so many upsides and so few downsides on a 2008 property. Look, if you brought this to me and you're like, this is an 1890s property, if I keep this, with this negative $200 cash flow every single month, remember, you got in on an FHA deal. You only put in 3.5%. People are like, oh, well, I don't want to have a negative cash flow. Well, then put more money down. So the fact that you put 3.5% down and you're in this situation where you're only down $200 a month is great. So I don't know. I like this. I like this deal so far. I've liked Rambling's deal. I've liked this deal. I wouldn't dump that one, and I would chase the one Rambling had. So let's see what else we got. Yeah, I'd love to analyze your deal. So guys, if you want me to analyze a deal, bring it in here. So I'll make a little note here. Keegan, send the details. So what else we've got? What else we have? Fallen Angel. So range view is listed with the Muni. Okay, so we're no link to a place here. Range view is listed with the city as a 5-unit apartment. Whether or not the mother-in-law can be converted to a 6th unit is hard to tell. It should never be hard to tell if a unit can be converted. You should be able to go to the city and find that out very, very quickly and easily. They'll give you the exact guidelines you need. They will hand this stuff to you. You just walk into City Hall. It's like, this is what I want to do. Help me out. And they're like, here's this printout, here's this printout, here's this printout. This is what you got to do. This is what it's going to cost. It might mean you have to get a contractor to see what it takes to qualify for all those things, but it's not that difficult. Used to be master. Okay, not sure. So to change the records to a fourplex. Okay, but my agent said a handful of conversion deals before. Okay. All right. But the current owners. So this is in response to another deal that we had looked at that I had actually responded to, where Fallen Angel. Let's see if we have a link here so we can kind of talk about it all together. I don't know where it is anymore. Okay, it doesn't matter. So here's the thing. When you get into a deal, and this was Fallen Angels, one of the things that we had talked about, when you get into a deal where it could either be a 4-unit or a 5-unit, if you can get the records updated with your county or your city, which means going to them and talking to them again, the same way I just said about what is it going to take to change this, if you can get it to be considered a 4-unit, that's great because the financing is very, very easy on a 4-unit. It becomes a lot more complicated when you're a 5-unit. But it doesn't also make sense to go through a crazy amount of expenses to convert this kind of property if you may as well just get commercial financing at that point. So let's see what else we have. You've got earthquake insurance is costly, adds about $1,000 a year. Yes, we talked about that. So earthquake insurance, I highly recommend if you have older properties. Not so important, in my opinion, on newer properties if you're in an area that's not expecting a lot of seismic activity. Now, people hear me say that in California and they're like, well, we're in California. Yeah, but my region will, when I look at our national data on earthquakes, and I see that my region says, and the national data that the government gives us says, the odds of having any kind of earthquake over a 7.0 in the next 50 years is 0. And I own newer properties like this. This is a 2007 build. I'm not so worried because I know this newer construction stuff can withstand a 6 and a 5 and a 4 and all that stuff. And if I lived in an area where I was expecting a bunch of 9.0s like Japan, yeah, I'd probably be more inclined to have earthquake insurance. It'd probably be more expensive too. The insurance companies, they look at this stuff, right? Yeah, but the 10% deductible, I hate that kind of stuff. So, all right. Fallen, I mentioned you a little bit. Touched on yours about 40 minutes in. Okay, so what else do we have here? So then we've got James. James has a deal in Orlando. I was just in Florida. I just got back yesterday. Orlando, you got it for $95,000. What do I think about it? Well, let's see. Another thing too, if you want me to look at like return on investments, it's good for you folks to give me rental data. What are you renting it for? Do you have a tenant already? So initially, it's a little close to our highways here. It looks like you've got a single family by the Days Inn. We've got some auto and storage facilities. So this sort of explains the price. When we start looking, we go, we're outside Orlando. Why is it so cheap? Well, it's closer to the highway. It's closer to some couple things. And golly, McDonald's really likes advertising to me. I love their ice creams. I would go for an ice cream right now. So let's look at it in detail here. Smaller deal. We are on this street. So this is actually this guy's got a mobile home right here next to some kind of tower. Not the best next to okay, that's a billboard tower. Not great for the neighborhood. So this is the property. This actually looks like it's going to be one of the smaller houses within the neighborhood. This guy's literally parking on the grass. Uh, I don't like seeing that stuff. The chicken wire, things like that. Okay, well, let's see what your cash flow is because this is maybe more of a developing neighborhood. It's going to be more of a, it's not your most highly rated neighborhood, but let's see what kind of, I guess a lot of people park in the dirt and the trash. So let's see what we got going on here. I mean, it looks like it's a siding bungalow. Honestly, this right here looks like an add on. I mean, look at this with the raised foundation right here, and then the steps right here, which the door is not even centered on the steps. So if you're in escrow on this thing, I mean, let me know what you got going on this thing. But if you're in escrow on this thing, you're gonna want to get some solid home inspections on this. I mean, we might even have a foundation separation going on right here to the structure of the property, and then we've got sort of this added on carport over here, which you can't park in anymore because of the storage. And here's another parked cop car in this case. Okay, so let's see if we can get some actual data on this because I don't have any rent numbers. I'm not super enthused right now. I'm not super excited by this one. I don't know if you could tell in my enthusiasm. Okay. So wait a minute. It's sold for $19,000 and two. Is this the right place? Gosh, it's just like when it gets so cheap, you got it for $95,000. So what are you renting the thing for? Built in 1952, so it's older on top of that. Listing removed. Oh, okay, here. Wow. So this was a flip possibly. These could have been the older photo or the ones that we were looking at were probably the older photos. So this was probably a flip. So they tried selling it. It sold for $20,000 or $19,000, whatever it was. They tried selling it for 100. Then they tried selling it for 125. It looks like after they rented it for a bit, and so you ended up getting it for 97. Okay. So I'd love to know what it I mean that appears to be the nicer version of what it is. They've obviously painted it and updated it. So for you to be getting let's reverse engineer this. For you to be getting a 14% return, which I always encourage you to be careful on that because you want to buy, in my mind, quality properties that in areas where they're likely to appreciate or come into more demand in the future, mostly just because you're going to associate yourself with tenants that are maybe interested in staying in the property longer. You get that longevity, you have less headache over time. But let's reverse engineer what you have. For you to be getting a 14% net on this thing, we're going to do 14.8% divided by, and then we've got, that's going to represent, let me do it the reverse way. So that way I can explain it to you all better. If you buy a place for $97,000, that's your purchase price. And then your income on this thing is, let's say, $20,000 over the year. Uh, and what you're going to do to get your net operating income is you're going to take your purchase price, put that aside for a moment. Then you're going to say, what's my income for the year? If my income for the year is, say, $20,000 and it's a single family house, we could take off about 30% for repairs, management, property taxes, utilities, repairs, so on and so forth. Write this down if you haven't yet. Timmer D. Taxes, insurance, maintenance, management, utilities, reserves. That's what you want. Write that down. Timmer D. Timmur D. Yeah, D is the little add-on depreciation, but that's not a real write-off. So that's just for taxes. Let's take our 30% off of that. So we're going to be left with 30%. So we're going to be left with a net income of 30% less than this. So we'd be left with $14,000 of income. And then this is going to give us a net operating rate of return, basically, our cap rate. So there's our 14% cap. So the rent that you would have to get a 14 cap would be $20,000 divided by 12. You'd have to be renting this for about $1,600 per month. I mean, look, if you're getting $1,600 per month, that's amazing. I don't think these things are renting for $1,400 a month and selling for $100,000, but maybe they are. So I, I don't know. So give me the rental numbers if you folks want me to look at these again in the future. But there's a lot of competition in the relatively inexpensive area here. $24,000. Like, oh, it's a mobile. Okay, yeah, mobiles, stay away from them. There's a short answer for you. So, what else we got? I like on the macro level, should expect to see price drops, but on micro level, say in a market where places are getting 6 to 10 offers a day, would you expect prices to increase? Yeah, you got it. Guys, got to be careful when you're talking about the market from the point of view of, oh, well, that guy got a bunch of offers. Well, maybe they underpriced it, just like the deal I'm buying. Oh, well, mine got 5 offers. I was the 6th offer on it. It was the last offer. They're usually the first offer. Well, yeah, because they underpriced it because it's an agent from out of the area that priced a plan 2 like a plan 1 that's 500 square feet smaller, and it doesn't even need that much work. I know. I'm local. They're out of the area. They don't know. They don't get it. Wedge deal. Information asymmetry, right? So let's see. I think let's see. What else we got in our Discord? And let's say James. Check. Today's live around, what was that? Around, look at that. How are we already so far in? 45 minutes in. All right. Next one. Let's do another one or two here. Can you look at this deal? Sure. Quang's got a deal. It's in Kitchener, Ontario, Canada. I have some potential capital partners looking into getting our first family. It's a big jump for me. I've never invested before, but I think at the price point, it's better to get into multifamily than single family, where the average price points are 650K. Also, can you recommend a starting? Okay. So let's look at this deal and let's see what we got. Quang, as far as other lectures we're coming up on this, yeah, this is a big deal. So for you to have never invested before and get into a $3 million property, that's big. In Canada, you have to generally put down 25 to 35% on commercial deals. So you got to ask yourself, you look at a deal like this, you look and you go, okay, well, I got to come up with, let's say you were able to buy the thing for 28.50, let's say. And now you have to come up with at least, let's say 35%, because maybe you put down 30%, but then you have closing costs, repairs, and all that. How are you going to come up with $1 million? That's the big question. And so then you ask, okay, well, maybe I can partner in with people. You've got potential capital partners. It'd be our first multifamily deal. Quang, by the way, is also in our real estate agent course. So we have these live stream dialogues as well about marketing yourself as an agent. But I think you folks all already know about that. $219,000 in annual gross income. Let's see what we've got going on in the hood over here. So if I go $219,000 of gross, this thing is selling for other way around. Hold on, wait for it. I haven't had any coffee yet today. I need to do that to get the engines firing correctly. This thing is selling for 13.7 times gross. It's very simple math. That's what I like about real estate is real estate math is very, very simple. Gross rent multiplier is only used for, in my opinion, comparing to other deals. Oh, I got that deal for 12 times gross. Why would I pay 13 for this deal? Or I paid 15 for that other deal. Wow, I could get this one for 13 and a half. And so what you want to do is look at sort of what your market's gross rents are in the area. As far as how good of a deal this is, we'll use their number. We'll see what they say, and we'll take off our 35%. So you've got a net income coming into this puppy of about 142K, rough math. 142 divided by, if you bought it for 28.50, let's say, that is too many zeros. Hold on. 142, there we go. It's a 5 cap. So here's a property that would give you a 5% rate of return. with 35% on your expenses if the rent was $219,000. Very important for you to do it. Well, it was built in 2015, so the odds of you getting a wedge deal on something like this probably a little bit lower because the newer construction deals, well, they're usually not, there's not a cosmetic issue. Well, remember your three wedges: cosmetic issues, selling low; cosmetically over improved, selling high; or rents are too low. The odds are the rents are going to be market rents and the conditions going to be fine. So you wouldn't be wedging getting into something like this. But I like it. I mean, I like controlling real estate like this. They say it's close to big box stores and parks and schools and all that kind of stuff. They've got an approved condo. Condo approved site plan may allow for additional future options. Blah blah blah. All right, whatever. All that future stuff, I usually just discard it. I mean, this is cute. This is beautiful. I mean, I really like the look of this building. They did a very nice job. It's tri-level though. I don't like tri-level. That's a minus for me because here's the problem: when you get these tri-level townhouses, what happens? People get tired of going up and down the stairs. Even normal people, like that, people that don't have issues going up the stairs, start having issues going up the stairs when you're in a tri-level. So, not super enthused anymore. Although on this side, you have two stories. Okay. So it looks like you got a mix. It blows my mind that somebody would have a $3 million listing and not have more pictures or more data. But whatever, I guess that's how they roll. So, all right, let's see what else we got. So, oh, test name is your did was yours the Orlando deal? Let's see. Newbie. Also, deal analysis. Did we look at yours, newbie? Did you have that in there? I gotta, for looking at deals, I gotta go down the deal analysis list, folks. So there aren't that many. I only got a couple others to go through here, so throw yours on there. But I will probably hit some more deal analysis ones Thursday. I want to hit some other questions, and then we're getting to like an hour already of me blabbing. That's too long. I applied for a HELOC. Any recommendations or suggestions? I will send pictures of my house later on. Yeah, I mean, so here's the thing: when you're getting ready to do a HELOC, you're basically getting ready for the appraisal, right? So minimize, get as much junk out of photos as possible, and really clean, touch up paint, whatever you got to do to clean, have your landscaping nice and manicured, stuffs away. Don't care if you shove it all into closets and stuff. All right, thanks. My ROI is a bit skewed. The tenant pays 1230. Yeah, so it is a little bit skewed. You're right. She wants to stay. I was thinking about a lease option. I linked some pics below. Okay. The tenant, I don't know if I would do a lease option. Just as a seller, I mean, why? If you wanted to get rid of it, she should buy it. Okay, newer AC, newer paint, the insides. I mean, this is kind of what you would expect for the price point. Uh, okay. I mean, I like that the tenant wants to stay because here's the thing: when this tenant moves, you've got some work to do. You got some work to do in terms of interior paint, cleaning it up a little bit, uh, bathrooms, kitchen, kitchen. Kitchen's missing some doors, but looks pretty decent overall. That's actually a lot better than I expected on the inside. I mean, if she wants to stay, why don't you just keep milking the rent? Uh, yeah, I mean, thanks for sharing those pictures. But yeah, I mean, it seems like you're getting even still like a decent amount of rent for $100,000. So let's see, 1,600 minus 1,230 equals. Where'd the 1,600 come from? And she wants to let's see, get it, but the neighborhood is not worth the 1,600. Yeah, exactly. So that's how I feel. Is brand new homes are asking 240. Yeah, thank you for looking that up on the MLS. So that's the thing. My initial reaction is, uh, we're in the lower price point. It's good that newer stuff is selling for 240. That's good. It kind of separates you away from this. But you have to ask yourself, test name one, do you what's the longevity? What's the long-term plan for this property? If you bought it for 97, what's it worth now? What could you sell it for max? And where would you put the money? Look, if you could dump this thing for $150,000 for putting in $20,000 or whatever, you'd probably break even on the sale. And at that point, it's like, well, why would I want to break even? Exactly. So at that point, you look and say, okay, well, maybe then it's better to just keep the property and just keep milking the rent. Pay $97,000 and you're getting paid 1,200 ish per month, even after repairs and property taxes, are 35% or whatever. Take off 400 bucks. You're still clearing 8 grand. Then you just ask yourself, well, what's the potential for the neighborhood? Are we going to see some growth in that neighborhood? If new construction is going in around the area, that could actually be a good sign that slowly that area would improve. I don't know. I mean, can you take some debt on it and buy something else? Are you living in a property that you own? Control some more real estate. I don't like selling real estate. I like the fact that it's definitely a cash flow. I mean, unless you have a ton of debt that I don't know about on that property at some ridiculous interest rate, I'm not seeing it as. I mean, I don't know that I would buy it, but if you already own it, I don't know that I would dump it. You see what I'm saying? And it's mostly because the like when you go to sell, you're paying all these fees. So you may as well just keep milking it. I don't know. Just my thought. So what else do we have here? Let's do it. Okay, James is your name. James. I can get it for 95. Wanted to know your thought. Okay. Wait. If you don't own this, I don't know, man. Okay. This changes it. This changes things. I thought you owned this thing and you were like stuck. All right. If you don't own this thing, I do not know that I would buy it. Because somebody bought it for 19 grand, basically painted the outside. See, I didn't want to be as blunt earlier. But the pictures you sent me, bro, they didn't do anything. I mean, look, they bought it for 19 grand. And what'd they do? Watch this. Here. They painted the outside. The windows are still original aluminum from probably when the place was built. Maybe they threw in a new condenser. Who cares? It's like 3 grand. I don't care about that. But look, I guarantee you this is what it was when they bought it. That tile is not 2-year-old tile. Neither is the paint, neither are the blinds, neither is the fan. They bought it 2 years ago. So what's 2 years new? Not that outlet, not that mirror, not that vanity, certainly not the toilets. Maybe they did do the new furnace, and that's probably why they're showing it off. But honestly, I think that's all they did is they painted it and threw in a new furnace. I'm not super jazzed about that one. So I'm gonna hand that off. Okay, cool. The HELOC question was for me. Yeah, hey, thanks. I love the dialogue in here, guys. Banks mentioned to only do a soft appraisal, non-walkthrough. I'm guessing using online data. Yes, that's correct. So when they do data for your HELOC, they'll on the one that you're moving out of, they'll run some quick sort of online matrices. But I've had them do that to me before, actually, while I was going through a HELOC process, where they go, "Oh yeah, that $550,000 property just appraised for $430,000 with our HELOC." I go, "What are you talking about? Like you guys are smoking." And they're like, "Oh well, our online metric told us it's 430." I go, "It's wrong. Order an appraisal." And she goes, okay, look, we'll order an appraisal, but you have to pay for it. And then if you end up getting the credit line, we'll reimburse you. I go, order the appraisal. I'll pay for it right now. I know it's worth 550. What happens? It appraises for 550, and the lender's like, "Oh my gosh, I can't believe our online software was so wrong." That's what happens. And if you're not a real estate broker and you're not in the game, you surround yourself with people who get it. And that can tell you actual values. So there you have it. That, folks, I think is going to include or conclude today's live stream. I was blabbing for a very long time here, but I really hope y'all learned something in watching this. If you ever want to watch these back, too, you can always like 2x speed them, unless that's like way too fast. But hopefully you got some nuggets from this, and definitely always want to answer all your questions. I will be back on Thursday. We got our agent live stream tomorrow, which we'll be catching up over there. And yeah, looking forward to answering more of all of your questions. Thanks, folks.